for the majority of breakouts are false moves. They are illusions, flashes of strength designed by the market's great manipulators, or by its own chaotic nature, to attract the hopeful public and then reverse, leaving them holding the bag. The speculator who consistently buys every breakout he sees is a man who has booked a passage on a ship destined for the rocks. The professional speculator, the man who has learned the deep and difficult lessons of the market, approaches a breakout not with greedy excitement, but with profound and warranted suspicion. He understands that a breakout is not, in and of itself, a signal to buy. It is merely a signal to begin paying very close attention. It is a proposition, not a conclusion. The great Jesse Livermore built his fortune upon this bedrock of professional skepticism. His method was not to buy breakouts, but to buy breakouts only after they had provided definite, conclusive, and undeniable proof of their own legitimacy. He did not act on promise, he acted only on evidence. This entire philosophy of demanding proof, of waiting for the market to confirm one's own judgment before committing significant capital, is a central theme in the chronicles of his legendary career. These timeless principles were documented with unparalleled clarity by Edwin Lefebvre. A link to his essential work, Reminiscences of a Stock Operator, can be found in the description below this video for those who wish to study the mind of a master. To understand how Livermore separated the true breakout from the false one is to understand the difference between scientific speculation and blind gambling. It was a methodical, evidence-based process, a clinical dissection of the tape's action, designed to answer one single question: is this move real? The first piece of proof was required long before the breakout ever occurred. It was the character of the stock's preceding action, the quality of the pivotal point itself. A breakout from a long, orderly, and well-defined consolidation base was a constructive sign. It showed that the stock had been under quiet accumulation by strong hands. A breakout from a chaotic, erratic, and wide-swinging pattern, however, was immediately suspect. Such a pattern indicated that the stock was in the hands of the public, not of professional interests. Livermore knew that no great sustained move could ever begin from such a disorderly foundation. He would study a stock for weeks, sometimes months, learning its character and its habits. He would watch it form its base. The breakout, when it came, had to make sense in the context of this long preparation. It had to be the logical culmination of a period of accumulation. A breakout that appeared out of nowhere from a faulty technical position was not an opportunity. It was an anomaly, and anomalies in the market are rarely to be trusted. The first proof, therefore, was a sound and orderly technical setup. The second, and perhaps most indispensable piece of proof, was the volume. A breakout that occurs on low or merely average volume must be considered a lie until proven otherwise. This was an ironclad rule from which there was no deviation. The reasoning is simple and irrefutable. A genuine market move, one that is destined to become a great and profitable trend, must be financed and supported by the immense buying power of large institutional interests. The public by itself does not have the financial might to sustain a major advance. The activity of these large players, the smart money, is invisible in the newspapers and in the brokerage houses, but it leaves a clear and unmistakable footprint in one place: the volume of trading. A breakout accompanied by a sudden explosive surge in volume is the clear and undeniable evidence that the institutional powers are behind the move. This high volume is the proof of sponsorship. It is the market's own testimony that the buying is powerful, aggressive, and coming from the sources that have the capital to see the move through. It is the sound of the starting gun for the real race. A breakout on thin volume, by contrast, is a whisper in a storm. It signifies that the buying is coming from the public, from the small, weak-handed speculators who are easily shaken out. It is often a deliberately engineered trap, a false move designed by insiders who are quietly distributing their stock into the public's manufactured excitement. Without the definite, conclusive proof of explosive volume, all other bullish signals were to be disregarded. It was the single most important piece of evidence in the entire case. To buy a breakout without this proof was to bet on a ghost. The third piece of proof was required immediately after the breakout occurred. It was the character of the follow-through. A genuine breakout, born of real buying power, does not hesitate. It does not look back. It moves with vigor and immediacy. Livermore's entire method of probing a position was designed to test for this immediate confirmation. After buying his initial small lot of stock at the pivotal point, he demanded that the market show him a profit almost at once. This was his first validation. The stock had to continue advancing for the next several days, pulling away from the breakout point with a sense of energy and purpose. It had to act right. It had to show by its own action that the path of least resistance was now decisively upward. If a stock broke its pivotal point and then, on the following day, it became sluggish, made no progress, or, worse, fell back below the breakout level, it was a profound danger signal. This was a false move. The breakout was a failure. The proof was negative. In such a case, the disciplined speculator does not wait. He does not hope. He does not give the stock a second chance to prove itself. He accepts the immediate verdict of the tape and sells his position at once, taking a small, manageable loss. The market has proven his initial judgment wrong, and he does not argue with the judge. To buy a breakout and hold on through a period of weakness, hoping it will recover, is to substitute the emotion of hope for the evidence of the tape. The professional demands immediate proof in the form of a profit. Without that proof, he withdraws from the field. The fourth piece of proof comes during the stock's first correction after the initial breakout thrust. No stock moves up in a straight line. It will advance, and then it will have a minor pullback to consolidate its gains. The character of this first pullback is a critical piece of evidence. In a genuinely strong trend, this first correction must be orderly, and above all, it must occur on significantly diminished volume. A pullback on light volume is the proof that the selling is not aggressive. It indicates that the institutional players are holding their positions, and the selling is merely the profit-taking of nervous, small-time traders. This is a sign of a stock that is in strong hands. The supply of stock for sale is small, and it is easily absorbed. After this brief and quiet pullback, the stock should then resume its advance, with volume once again picking up as the price moves higher. Conversely, a stock that has a deep, sharp pullback on heavy volume after a breakout is providing proof of its own weakness. This indicates that the initial buying was not sustained and that heavy institutional selling is now coming into the market. The trend's legitimacy is now in serious doubt. The fifth piece of corroborating evidence must come from the stock's peers. A true market trend is rarely a solo performance by a single stock. It is a group phenomenon. The speculator must demand proof of this group action before he can have full confidence in his position. If a leading steel stock breaks out, the disciplined speculator will immediately turn his gaze to the other major stocks in the steel group. They do not all have to break out on the same day, but they must show signs of similar strength. They must confirm their leader's move. They should begin to move toward their own pivotal points. Their volume should increase. They should exhibit a sympathetic strength. This is the proof that a fundamental and powerful force is at work, lifting the entire industrial sector. If the leader breaks out and its sister stocks remain dormant, lifeless, and heavy, the breakout in the leader is immediately suspect. It is like a general charging forward while his army refuses to follow. Such an advance cannot be sustained. It is likely a move based on some company-specific news or a manipulative operation. This group confirmation is the proof that the trend is broad, authentic, and has the power to endure. Without it, the speculator is betting on an isolated and therefore vulnerable position. The sixth and final piece of proof, the verdict of the Supreme Court, must come from the general market itself. A breakout by even the strongest stock in the strongest group is unlikely to succeed if it is fighting against the tide of a weak or declining general market. The speculator must demand proof that the line of least resistance for the market averages is aligned with his trade. For a long position, the overall market must be in a confirmed and healthy bull phase. It should be making new highs or at least showing a strong and constructive character. To buy a breakout in a hostile bear market is to engage in a low probability gamble. It is to bet that one single stock has the strength to defy the gravitational pull of the entire market. While this can happen on rare occasions, it is not the basis for a sound and consistently profitable speculative campaign. The professional speculator always seeks to have the powerful force of the general market trend at his back. To ignore this great overarching force is to be willfully blind to the most important factor that will determine the success or failure of a trade. This leads us to the great sin of the impatient amateur, the sin of anticipation. He sees a stock consolidating near its high and becomes tired of waiting. He convinces himself that a breakout is inevitable, and so he buys the stock before the breakout occurs, hoping to get a cheaper price. Livermore knew this to be a cardinal and costly error. The speculator is not paid to be a fortune teller. He is not paid to anticipate. He is paid to be right. And he cannot know that he is right until the market itself provides the proof. By buying inside the trading range, the trader is acting on hope, not evidence. He may save himself a point or two on the price if he is right, but he exposes himself to a significant loss if his anticipation is wrong and the stock breaks down instead of up. The professional speculator is willing to pay that extra point after the breakout, for that point is the price he pays for insurance. It is the price of confirmation. It is the price of waiting for the market to show its own hand. The amateur buys on hope. The professional buys on proof. This is a fundamental and non-negotiable distinction. The very method by which Livermore traded was, in itself, a system for demanding proof. He never, under any circumstances, committed his full line of capital at the moment of the initial breakout. To do so would be to make an enormous bet on a single piece of evidence. Instead, his first action at the pivotal point was to send out a scout, a small exploratory position. This was his probe. This probe was not a trade in the conventional sense. It was a question he was asking the market. The question was simple. Is this move genuine? The market's answer had to be equally simple and immediate. The proof he demanded was a profit. If the probe position immediately went against him, the market's answer was no. He would then close the position and his investigation was over. Only after the market had answered yes, in the form of a quick and decisive profit on his probe, would he consider committing more capital. Each subsequent addition to his line, each step of his pyramid, was entirely dependent on the market providing further proof in the form of a continued rising price. He was not buying a breakout. He was reinforcing a proven success. His method was designed to ensure that he only had his largest positions on when he was most right, and that he was only ever risking a small amount of capital on the initial unproven breakout itself. In the final analysis, the speculator must see himself not as a participant in a game of chance, but as a judge presiding over a case. The breakout of a stock is merely the opening argument by the prosecution. It is a claim, an assertion, a piece of initial testimony. The wise judge does not deliver a verdict based on the opening argument alone. He sits back and patiently demands to see all the corroborating evidence. He listens to the testimony of the volume. He observes the character of the follow-through and the nature of the first cross-examination, the first pullback. He looks for the testimony of corroborating witnesses, the sister stocks in the group. And finally, he considers the overall legal precedent, the state of the general market. Only when all the evidence is in, when all the witnesses are in agreement, when the case for a sustained advance has been made beyond a reasonable doubt, only then does he deliver his verdict by committing his full line of capital. To buy a breakout without this rigorous, disciplined, and evidence-based process of demanding proof is the fastest and most certain path to speculative ruin. It is the mark of the amateur, the impatient gambler who is destined to feed his capital to the cool, patient, and methodical professional.